Welcome, dear traders. You are watching a recap of the Asian session. Japanese and Australian equities regained momentum following an improved sentiment on Wall Street. New Zealand stock indexes, on the contrary, fell to the almost 4-week low in the morning. At the same time, other stock markets in the Asia-Pacific region may slide into a bearish zone due to economic woes in China. A sluggish recovery of the Chinese economy and escalating trade conflict with the US continue to adversely affect the sentiment in the Asian markets. Although China's trade balance showed some growth, imports and exports contracted. According to fresh data, China's imports decreased by 12.4% due to weak domestic demand in July, marking the fifth consecutive month of fall. It was also the sharpest drop since May 2020. Exports tumbled to 5-month lows, logging a 14.5% annual decline. Thus, the recovery of China, Asia's economic engine, keeps slowing down, undermining growth in the whole region. Apart from economic problems, trade tensions with the Asian and Western partners, Japan, India and the United States are mounting. For example, India recently stopped importing laptops and computers. It also barred domestic manufacturers of military drones from using components made in China. The conflict over Taiwan is also far from being over. Apart from that, Typhoon Doksuri, which hit China last week, also created more problems. According to Chinese media, almost 100 cities and districts of Hebei province were flooded during the disaster. Beijing has experienced the worst flooding in the last 140 years. Given these problems, the prospect of stimulating the battered economy by the Chinese authorities looks less likely. However, some investors do not lose hope. In addition, the stimulus measures may not lead to a rapid revival. Over the past 2 weeks, China has only slightly supported the real estate market. No more stimulus measures have been taken despite the promises of policymakers. Fed officials have recently made plenty of comments. New York Fed President John Williams sees the need to keep U.S. monetary policy restrictive for some time, and Fed Governor Michelle Bowman assumes that the Fed could stick to aggressive tightening to achieve the 2% target. Actually, both politicians repeated that other Fed policymakers had previously stated. Further rate decisions will depend on the incoming data. Non-farm payrolls data published last Friday showed elevated demand for labor force in the country. Therefore, Fed officials are wary of the risks of a higher inflation and back further tightening. The Fed leaves the door open for another rate hike in September or November. The yield of Treasury notes advanced following those statements. It was a bullish factor for the US dollar. In the Asian session, the US currency rose across the board. It has been gaining momentum for the second day in a row. On Tuesday morning, the US dollar increased even more significantly. The US dollar index, which tracks the greenback against a basket of 6 major currencies, jumped to 102.30. The economic prospects of the United States and China differ considerably these days. It makes investors revise their portfolios, especially due to the disappointing Chinese trade data. The borders of the intraday range of 102 and 102.40 may shift even higher. The US dollar also grew against the yen, which ended the Asian session on a consolidation near 141.30, following a rise in the yield of Treasuries, and the dollar-yen pair advanced to 143.40. Of course, this price is still far from its annual high of 145.07 reached on June 30. Demand for the greenback is growing, boosting the upward movement of the pair. In addition, Bank of Japan policymakers stated that they intend to maintain an ultra-loose monetary policy at the beginning of this week. All these factors are extremely bullish for the greenback. Therefore, on a Tuesday, the pair was moving in the upward range of 142.30 and 143.40. The resistance level is located at 143.45. Bulls could push the price to 143.90, a high over August 3. Commodity currencies, which are sensitive to risk sentiment, sank today because of negative news from China, and the Australian dollar snapped its three-day winning streak, sliding into a negative price corridor of 0.6515 and 0.6577. Yet, Wall Street closed yesterday with the first intraday gain in 5 sessions. In addition, oil prices are still hovering near their 4-month highs. It limited the downward movement of the Aussie, and it may even rebound in the American session. The Aussie ended the session below 0.6520. The Kiwi looks like the main outsider on the forex, against the backdrop of the deteriorating economic prospects and the possible end of a monetary tightening by the Reserve Bank of New Zealand. The Kiwi is unable to recover. After the meeting on July 12, it's likely to dip to the lower border of the range, and the Kiwi dollar pair has been moving in the range of 0.6000 and 0.6400 since March. It ended the trading session falling below 0.6050. If it declines below 0.6000, the bearish pressure on the pair will increase even more. And that's all for now. Leave your comments down below and see you soon.